Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The dramatic price action in Novo Nordisk, NVO, at the close of 2025 gave us one of the clearest examples of market forces just colliding. So on December 22nd, the FDA approved oral Wegovy, and the very next day, the stock surged an astonishing 9%. A move, it's almost unheard of for a blue chip pharmaceutical giant. The source material, it really captures the magnitude of this event, but it leaves us with this critical disagreement. Was this violent repricing primarily driven by the overwhelming fundamental value that was unlocked by the catalyst, or was the speed and magnitude of that 9% surge mechanically dictated by the underlying market structure, institutional positioning, options flow? I'm going to argue this was a long overdue fundamental re-rating, and it was necessitated by some truly game-changing commercial prospects.
See, I come at it from a different angle. While the FDA approval was undeniably the spark, it was the necessary input, the resultant explosion, that full 9% upward spike, that was the signature of the market's plumbing at work. The speed and the scale of that rally tell a much richer story about how concentrated positioning, specifically, trapped short sellers and leveraged options hedging, can amplify fundamental news far, far beyond its immediate calculated value. My position is simple. The fundamentals provided the justification, sure, but the underlying market structure provided the maximum possible fuel. Okay, but let's ground this conversation first in the commercial reality that necessitated the re-rating. This approval represents a profound strategic inflection point because it transforms NVO. It sheds its identity as a specialized injectable biologics firm and enters this massive arena of mass-market consumer healthcare. The oral pill removes the single greatest barrier to entry for millions of potential patients, trypanophobia, the fear of needles. Our research showed that the needle barrier may have kept 20 to 30% of the eligible population out of the GLP-1 market entirely. This removal doesn't just increase market share, it expands the total addressable market by millions of people overnight. That is a fundamental expansion of potential revenue streams that just demands a new, higher valuation framework.
That's an interesting point, though I would frame the timing a little differently. If this was simply a fundamental re-rating based on an increased TAM, then why the urgency? We have to look at the technical evidence that institutional capital was already positioned aggressively before the news broke, which suggests this was a highly anticipated, timed event. We need to examine the plumbing of the market to see the quiet accumulation that came before the announcement. From December 10th through the 22nd, so the days leading up to the approval, we saw elevated daily non-exempt volume, or NEV. And for listeners who are less immersed in market microstructure, NEV is our best proxy for off-exchange trading activity, primarily in dark pools, where institutions execute these huge orders without publicly revealing their interest or, impacting the price on the lit exchanges. This volume consistently hovered between 1.2 million and 2.1 million shares per day. This was smart money accumulating shares quietly, just absorbing the supply that retail investors were capitulating on when the stock was trading near its perceived lows.
But that institutional positioning was only validated because the catalyst itself was so robust. Not only did they solve the convenience problem, but they also solved the technological validation problem. Analysts were deeply concerned that turning the injectable semaglutide into an effective oral pill would severely compromise its efficacy because of poor absorption. But the efficacy data from the OS4's phase 3 trial, it exceeded all those fears. The trial delivered a 16.6% mean weight loss over 64 weeks. This validated their proprietary snack absorption enhancer technology. And why is 16.6% so crucial? Because it confirmed statistical parity with the injectable version, which yields 15 to 17% weight loss. It proved they could maintain the medical and commercial viability of the injectable drug while eliminating the major consumer drawback.
I agree that the efficacy figure was crucial, absolutely, for calming the specific technological fears that had built up in the bear camp. Analysts feared the oral bioavailability would drop efficacy below 10%, crippling commercial success, but 16.6 proves true parity. It eliminates that specific risk. But the move was driven by more than just medical efficacy. It was driven by a commercial strategy that broke the historical business model.
You are referring to the pricing strategy.
Precisely. The advocate needs to talk about the strategic implications of the pricing, because that is the real masterstroke here. Novo Nordisk struck a deal referenced in the source material as the Trump RX deal to price the starter dose for self-pay patients at a disruptive $149 per month. This is key because it functionally allows NVO to bypass restrictive pharmacy benefit managers, or PBMs, and insurance formularies. PBMs often use these onerous pre-authorization requirements and high copays to restrict access to expensive new drugs. By offering a medically proven needle-free product at a price point that makes patients self-pay competitive, a subscription-like price, the company pivots from a B2B model, which is dictated by formulary gatekeepers, to a direct B2C model. They uncap demand by going directly to the consumer, turning millions of potential patients into immediate customers. When you combine proven efficacy, massive uncapped demand, and a solved convenience hurdle, well, a 9% move looks fundamentally necessary, not technically anomalous.
I'm not convinced that that reasoning holds up entirely, because the specific mechanism of the 9% move shows clear signs of technical acceleration. Let's look at the options market on December 23rd, where the Gamma engine fired. This is where the structural leverage lies. We detected massive unusual options activity, UOA, that morning, specifically a single block trade involving 20,000 call contracts. And crucially, the volume to open interest ratio exceeded 500 times, signaling aggressive new leveraged money entering the market with extremely high conviction about the price spike.
And why does that one trade force the stock price up 9%?
It forces market makers, the MMs, the entities who sold those 20,000 calls, to hedge their resulting gamma exposure and maintain delta neutrality. Delta neutral hedging means that for every call they sell, they have to buy a certain number of the underlying stock, NVO, to ensure they don't lose money if the price moves against them. As the stock price starts to rise on the initial fundamental news and short covering, the delta of those calls increases, forcing the MMs to buy even more stock to re-hedge their position. This is the reflexive, self-fulfilling feedback loop. It's like trying to brake a train going downhill. The faster the price moves, the harder the system has to push to keep up, creating that powerful mechanical acceleration that just disproportionately inflates the rally beyond what a pure fundamental calculation might suggest.
I acknowledge the power of that feedback loop, but it only kicks in when there is sufficient fundamental justification. That brings us directly to our first core point of disagreement: the valuation arbitrage versus technical noise. Throughout 2025, NVO is trading at a highly compressed 13 to 15 times forward price to earnings multiple, a PE multiple. It was priced like a generic drug manufacturer with zero growth, even as it pioneered this massive new therapeutic category. In stark contrast, its primary competitor, Eli Lilly, LLY, was trading above 50 times PE, reflecting extreme optimism about their pipeline. The market was irrationally punishing NVO due to legacy fears about its injectable platform and this perceived technological inferiority. The 9% rally wasn't technical noise. It was the market violently beginning to correct this massive, glaring valuation disparity, finally viewing NVO correctly as one half of a powerful duopoly in a market that's rapidly heading toward $100 billion. The fundamental valuation gap was the potential energy. The FDA news was just the release mechanism.
The valuation gap absolutely provided the reason for the move, but the price action reflects urgency over deliberation, which is a clear technical signal that institutions were betting on timing. If it were pure, reasoned valuation correction, the institutional funds accumulating those 1.2 to 2.1 million shares in the dark pool would have been patient, executing their trades quietly over a longer period. Instead, we saw extreme volatility crammed into 24 hours. Remember the sweep orders detected on December 16th? These were very large institutional orders split across multiple exchanges, executed specifically at the offer price. When a professional trader executes a sweep order and explicitly pays the offer price, it signals that they prioritize speed over minimizing the cost. They didn't care about getting the best fill, they cared about getting their size filled immediately before the news became public. This confirms a high-conviction technical bet on the timing of the FDA announcement, anticipating the gamma squeeze and short covering, not just the eventual fundamental value.
But isn't prioritizing speed over price just the hallmark of high-conviction fundamental research, not necessarily a technical bet? It was high conviction because they knew the bear thesis that NVO was technologically inferior and doomed to legacy status was suddenly dead. However, we have to address the other major mechanical amplifier you mentioned, the short interest.
Yes, the squeeze fuel was substantial. NVO's short volume ratio was remarkably high throughout December, fluctuating between 30 and 38% of the total off-exchange volume. Now, while some of that is benign hedging, market makers facilitating institutional dark pool buys, for instance, a persistent ratio in the high 30s suggests a very, very large component of directional shorting. Hedge funds were explicitly betting against the oral approval or were running relative value trades, hedging long LLY positions against short NVO positions. The FDA approval trapped those directional shorts. They were forced to cover their positions, which means they had to buy back shares, adding immense inelastic buying pressure directly on top of the gamma hedging and the fundamental buyers. This dynamic is precisely what amplified a potential 3 or 4% fundamental rally into that stunning 9% short squeeze surge.
That confluence of structural forces certainly explains the mechanics of the upward slope, but the long-term sustainability has to rely on the commercial moat. This brings us to our second contention, the competitive landscape and the durability of oral Wegovy. You, my counterpart, have consistently pointed to its long-term weakness against Eli Lilly's pipeline.
I'm sorry, but I just don't buy that the moat is secure for the long run. Let me tell you why. The oral product has a built-in compliance hurdle that will erode its advantage. The primary weakness is the persistent food effect. Oral Wegovy requires patients to take the pill on an empty stomach with minimal water and then wait 30 minutes before eating or drinking anything else. That is a significant patient compliance concern that will absolutely erode the long-term competitive moat, especially in a mass market setting. Contrast this with Eli Lilly's orforglipron, which is a small molecule drug without such restrictive compliance requirements. The research we saw suggested that adherence could be low for NVO's oral products specifically because of this restriction, potentially negating the advantage gained by removing the needle.
That's an interesting point, though I would frame the competition differently. You're prioritizing the theoretical future compliance risk over the concrete, regulatory, and commercial timing advantage that NVO has secured. Novo Nordisk secured first-mover execution in the oral segment, launching in early January 2026. This guarantees them an effective monopoly in the oral GLP-1 segment for months, maybe even a year before orforglipron potentially arrives. Market share gained early is market share defended later. And the brand loyalty created by being the first, safe, effective oral option is powerful. Furthermore, you emphasize the complexity of the drug mechanism while ignoring the physician's conservative nature, which is the true moat here. Oral semaglutide is merely a different formulation of a known, widely trusted molecule, Ozempic and Wegovy, which has years of established safety data. Orforglipron is a novel chemical entity. Conservative physicians who drive the bulk of high-volume prescribing will overwhelmingly prefer prescribing the known entity with a proven multi-year safety profile over the new small molecule until its long-term safety is fully established. This regulatory and safety advantage provides a robust structural moat for NVO in the crucial early years of this segment.
A temporary moat, perhaps? Based on perceived safety, which can change rapidly with new trial data from competitors, it doesn't solve the daily logistical hurdle for the patient.
Safety perception is everything in mass-market pharmaceuticals, especially when you're dealing with drugs taken long-term. This brings us to our third point, the role of investor psychology in accelerating the technical move.
I believe the catalyst fundamentally reversed retail psychology overnight, justifying the institutional bets. Throughout 2025, NVO was widely viewed as a value trap. The sentiment was dominated by the Lilly superiority complex, where investors focused solely on Lilly's seemingly superior technological advancements, the dual and triple agonists. The failure of NVO's peripheral trials like the Alzheimer's program only cemented this pessimism and drove the stock to its 4-year low.
The vitriol was high, yes. Retail users were criticizing management heavily, accusing them of hyping the pipeline without delivery.
Exactly. But the oral pill approval pivoted the entire narrative. The focus shifted from technological superiority, where Lilly was perceived to lead, to commercial execution and convenience, where Novo Nordisk now had the approved product. What was seen as a crash was instantly flipped into a huge buying opportunity by retail investors, who realized the market had irrationally punished NVO due to misplaced pessimism. The consensus shifted to the simple, understandable pill narrative: convenience is king, which provided the massive, necessary momentum for the 9% move to hold.
I agree that retail provided the momentum, but they were following the institutional signal that was already established. The retail euphoria needed the technical framework to materialize the 9% move. The underlying structure, the institutional accumulation in dark pools, the 2 million shares of non-exempt volume, and the subsequent forced short covering provided the necessary liquidity and upward pressure for that retail euphoria to take hold. You can't have a 9% surge purely on sentiment without the institutional signal cleaning up the supply.
Furthermore, we cannot ignore the macro environment that acted as a necessary tailwind on that specific trading day.
You are referring to the economic backdrop?
Precisely. The price action on December 23rd was significantly aided by stronger than expected macroeconomic data. The U.S. GDP data for Q3 was released, showing a robust growth rate of 4.3%, decisively beating the conservative 3.2% forecast. This single data point triggered a broader, immediate risk-on sector rotation across the board. Capital flowed immediately out of defensive positions and aggressively into high-growth names like NVO. If the fundamental catalyst that hit during a period of macro stress or market contraction, the technical amplification from gamma and short covering would have been dampened, resulting in a much smaller fundamental move. The simultaneous alignment of the catalyst, the leveraged options positioning, the short squeeze dynamic, and the strong macro data is precisely what gave us the maximum possible 9% surge.
So you argue that while the fundamentals were necessary to establish the new commercial opportunity, they were insufficient to explain the quantum of the move. Whereas I argue the fundamentals were overwhelmingly sufficient to justify the re-rating, and the technical factors merely accelerated an inevitable, necessary correction to close that PE gap.
I would say the technical factors ensured the correction happened violently, maximizing the price impact into a single trading day, which is the key characteristic of this event.
We certainly agree that the events of December 2025 mark a definitive structural shift in the narrative surrounding Novo Nordisk. The bear thesis of 2025 has been conclusively cleansed. The approval of oral Wegovy, backed by 16.6% efficacy data, fundamentally allows NVO to shed its legacy injectable image and fully embrace the B2C mass market model, especially with that strategic $149 pricing structure that bypasses key regulatory hurdles. This shift justifies a return to a PE multiple closer to the 30 to 35 times range, closing the irrational valuation gap that existed with its main competitor. The rally reflects sustainable value.
And I will reiterate that, while the value exists, the exceptional volatility in the specific 9% magnitude were the signature of high-octane market mechanics. The convergence of remarkably high short interest, the leveraged options positioning forcing that crucial market maker gamma hedging, and the institutional accumulation detected in the dark pools, that consistent 1.2 to 2.1 million shares of non-exempt volume, are the forces that engineered that vertical acceleration. The discussion underscores a vital lesson. When a powerful paradigm-shifting catalyst meets severe technical constraints in concentrated positioning, the resulting price movement is often disproportionately large and compressed into a rapid window.
It forces the serious investor to analyze not just the clinical trial data and commercial strategy,
but also the opaque plumbing of the market to truly understand the price discovery mechanism that delivered that 9% surge.
Indeed. The challenge now is determining whether that new price reflects sustainable fundamental strength or whether the technical exhaustion from the squeeze will lead to consolidation. The only certainty is that understanding the market requires a sophisticated analysis of both the narrative driving the business and the structural mechanics that facilitate the price action.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.